BlackRock manages approximately $7 trillion of retirement money. That's roughly half of everything they touch. And in 2026, they are doing something with that money that was technically impossible 5 years ago, that most financial advisors won't explain to you. And that is being greenlit at the highest levels of Washington right now. The specific move they are making will restructure what sits inside the default retirement fund of possibly millions of Americans. And it was designed in a conference room, not by you. That's not anxiety bait. That's just the sequence of events. Here's what I'm going to walk you through today. BlackRock's business model has 3 distinct layers, and almost all of the public conversation stops at layer 1. I'm going to take you through all 3, explain what's actually changing in 2026, and then give you 3 specific things that are actionable based on this. Not save more and diversify, specific things. We'll also run through one realistic case study that makes the math land in a way that's hard to unsee. Before any of that, I need to give you a frame that's going to anchor this whole conversation. Because most people think about BlackRock the way you think about a big mutual fund company, a more sophisticated version of Vanguard, maybe. That framing is about as accurate as calling Amazon a bookstore. Here's the actual frame. BlackRock is a default, not just a company, a default option. When you started your job and filled out your HR onboarding paperwork, you probably checked a box next to your 401k contribution percentage. Most people don't pick specific funds. They get automatically enrolled in the plan's default investment. That default, for a massive percentage of American employers, is a BlackRock target date fund. You didn't choose it, it chose you. And in finance, the default is everything. The default is the thing that captures money when no one is paying attention. The default is the thing that compounds for 30 years before anyone looks closely. The default is, and this is not hyperbole, the most powerful real estate in the entire financial system. And BlackRock has owned it for 30 years. So as we go through everything I'm about to show you, keep that word in your head. The default. Every new product, every acquisition, every regulatory push. It all makes sense when you understand that the goal is to maintain and expand control over the default. In a few minutes, I'm going to show you what happens when the company that owns the default position in your retirement fund also owns the software that tells other financial institutions how to price risk. But first, let me show you why the target date fund was the smartest land grab in modern finance. Back in the early 90s, before most of us knew what an index fund was, BlackRock introduced something called LifePath, a target date fund. The idea was simple and genuinely useful. Pick the year you want to retire, invest in one fund, and let the fund automatically shift from aggressive growth toward conservative income as you get closer to that date. Put it on autopilot. You pick the year, the fund does everything else. They called it taking the guesswork out of saving for retirement. It worked, and it worked so well that the Pension Protection Act of 2006 codified it into law. Target date funds became the primary qualified default investment alternative for employer-sponsored plans, which means employers got legal protection for automatically enrolling their employees into target date funds without asking. The default didn't just become popular, the default became the law. As of the end of 2025, there are now over $5 trillion sitting in target date funds across all managers. 5 trillion. BlackRock alone controls $611 billion in target date assets. The LifePath fund is used as the default option by 20% of Fortune 100 companies. If you have a 401k and you've never manually selected your investment options, there is a meaningful probability that you are currently inside a BlackRock fund. Not because you're a BlackRock customer, because your HR department was. Now I want to be precise about the fee picture, because this is where the numbers either reassure you or make you genuinely uncomfortable. The industry average expense ratio for target date funds, according to Morningstar data as of December 31st, 2025, is 0.41% annually. Vanguard's average is 0.08%, roughly 5 times cheaper. BlackRock's LifePath index, the passive index-based version, runs competitively cheap. But not all target date funds in your plan are necessarily the index version, and that matters. According to a 2025 ICI study, the average 401k equity mutual fund expense ratio was 0.26% in 2024. And that's just the fund layer. Most 401k plans have additional administrative fee layers on top of the fund expense ratio, a plan administration fee, a record-keeping fee, sometimes an advisor fee that add another 0.25 to 0.5% annually. And almost nobody knows about them because they don't show up on your statement as a line item. They just quietly reduce your return. Here is the math that should land. On a $200,000 portfolio with $10,000 in annual contributions over 30 years, a 1% difference in annual fees costs you approximately $469,000 in lost compounding, not fees paid out of pocket, wealth that was never created, the opportunity cost of the invisible fee. A FINRA Investor Education Foundation study found that investors with the lowest financial literacy scores pay fees more than 10 times higher than investors with the highest literacy. Not twice, 10 times. And those investors aren't stupid people, they're busy people. They're people who trusted the default. By the way, hit subscribe if you like the content. Otherwise, YouTube's algorithm may never show you my videos again. Here is the thing I need you to hold on to as we go deeper. This is where it gets really interesting. Most people think the target date fund is the product. It's not. The target date fund is the distribution channel. The real product is being built right now. In June 2025, BlackRock announced that it would offer a 401k target date fund with 5 to 20% allocated to private investments, private equity, private credit, infrastructure, real assets, asset classes that for the entirety of the 401k era have been available only to institutional investors, pension funds, sovereign wealth funds, university endowments, and very wealthy individuals. By July 2025, BlackRock CFO Martin Small confirmed on the firm's second quarter earnings call that a proprietary LifePath version with private assets was launching in 2026. This is not a proposal. It's already in motion. The case for this is not zero. I want to say that clearly, because the most useful analysis is one that takes both sides seriously. Pension funds, the old defined benefit plans, the kind that still exist for government workers and some union employees, have held private equity, private credit, and infrastructure as core portfolio positions for decades. And according to BlackRock's own research, that has helped them outperform typical 401k portfolios over long periods. The playing field between institutional and individual retirement savings has always been uneven. If private assets genuinely add returns, the access argument has real merit. BlackRock estimates that incorporating private assets into a target date glide path could add about 50 basis points of returns annually, translating to a 15% boost in account value over 40 years. That number is not made up. It's the basis of a rational argument. But there is a version of this story that is less flattering, and understanding it requires knowing what BlackRock did in 2024 and 2025. They bought Global Infrastructure Partners in 2024. That fund just closed a $25.2 billion deal. In 2025, they closed a $12 billion acquisition of HPS Investment Partners, one of the leading private credit managers in the world. These are two massive private markets businesses. They represent a huge bet now complete on the private asset class. And Larry Fink, in his 2025 shareholder letter, was direct. He wants to bring private assets to everyday investors through the retirement system. So, BlackRock spends tens of billions of dollars buying private market businesses. BlackRock then routes those same businesses' products into the target date funds it manages for your 401k. The target date fund is the default. You never had to opt in. That is not conspiracy. That is a business model. And it's a good one if you're BlackRock. The question is whether it's a good one for you. Let me give you the other side of the performance argument, because it matters. A review by the Private Equity Stakeholder Project found that the 15 largest private equity-focused evergreen funds aimed at retail investors, the kind of vehicles that would go into a 401k, produced a median return of 11.97% in 2025. The S&P 500 returned 17.43% that same year. Over the 3 years from 2023 through 2025, those retail-targeted private equity vehicles generated a median annualized return of 11.31% compared to the S&P 500's 22.48% over the same window. That performance gap came on top of expense ratios ranging from 3 to 5% annually. The classic private equity fee structure is 2 and 20. 2% annual management fee on committed assets plus 20% of profits above the hurdle rate as carried interest. Compare that to BlackRock's LifePath Index at roughly 10 to 15 basis points. The private portion of a new hybrid fund could run 15 to 20 times more expensive per dollar invested. The SEC flagged this directly. It called private investments in 401k plans a 2026 priority, specifically citing fees that often exceed 2% and limited transparency in private asset valuations. On top of fees, illiquidity. Private assets can't be quickly sold. A 5 to 20% allocation to illiquid holdings inside a target date fund creates a structural mismatch if markets get volatile and participants need access. The valuation of private assets lacks daily pricing, which means during a market downturn, you might not even know accurately what your portfolio is worth. For someone 2 years from retirement, this is not a theoretical concern. I want to pause here because there is a larger pattern worth naming. For 30 years, retirement savers watched institutional investors, pension funds, endowments, family offices compound wealth using private assets that were off limits to regular people. That gap was framed as a regulatory protection. Now the gap is being closed. The same asset managers who ran those pension funds and charged institutional fees are now selling access to those same assets to individual 401k participants on terms they set through distribution channels they already control. The pension fund era helped build BlackRock's private markets expertise. The 401k era gave them the distribution network. The convergence of those two things is exactly what 2026 is. Somewhere in a conference room, a 42-year-old HR manager is being asked to sign off on a new retirement plan that includes private credit exposure through a custom target date glide path. He has no idea what private credit is. He nods. Stay with me, because the fourth layer of this is the most behaviorally interesting piece of the whole story, and it's the one most people have never heard of. In April 2024, BlackRock launched something called LifePath Paycheck. As of the end of 2025, it had grown to $27 billion in assets under management. For reference, 12 months earlier, it was at $16 billion. That growth rate is not normal. Something is working. Here is what it does. LifePath Paycheck is a target date fund, but starting at age 55, it begins diverting roughly 10% of your portfolio into what it calls lifetime income units. By age 65, approximately 30% of your balance has accumulated in these units. Then, and this is the key mechanism between ages 59 and a half and 71, you have an option. You can use those units to purchase an annuity from one of two insurers that BlackRock has selected, Actionable and Brighthouse. The annuity converts what you've accumulated into a guaranteed income stream for life. The idea behind this is genuinely sound and responds to a real psychological problem. BlackRock's own Read on Retirement survey found that 66% of workplace savers are worried about running out of money in retirement. 90% say guaranteed income in retirement would help. Americans are terrified of outliving their savings, more terrified of it than they are of death itself, which is a sentence that should stop you for a moment. People fear outliving their money more than they fear dying. That is a solvable financial engineering problem, and BlackRock is solving it. But let me walk through the business model anatomy, because it is elegant. BlackRock is not the insurer. Actionable and Brighthouse take on the longevity risk, the risk that you live to 93 and keep collecting. BlackRock's role is to manage the accumulation phase over 20 to 40 years, guiding the money toward the annuity structure, while collecting management fees at every step. The annuity purchase window reportedly comes with no additional fees from BlackRock directly. But you will have spent 3 or 4 decades accumulating inside a BlackRock target date fund before you ever reach that window. The fee revenue was collected long before the annuity conversation starts. And here's the detail that tells you how serious BlackRock is about this product. In 2024, They made LifePath Paycheck the default investment option for their own employees. BlackRock's internal retirement plan has approximately $4.1 billion in assets and served over 14,400 participants as of late 2023. They are running the beta test on their own workforce. When a company uses its own people as the reference case, that is either deep conviction or extremely confident product market fit signaling to potential institutional clients. Probably both. Now, zoom out to the political architecture around this because it is not accidental. In March 2025, Larry Fink hosted a retirement summit in Washington, D.C. Republicans and Democrats, asset managers and pension funds, small business owners, firefighters, teachers, union members, and farmers. Fink himself wrote about it in his annual letter, describing a coalition organized around practical ideas to help more Americans build retirement savings. That framing is doing a lot of work. When the CEO of the world's largest asset manager hosts a bipartisan summit in Washington, the same year he is seeking regulatory changes to allow private assets into 401k plans, and the same year he is seeking expanded distribution for LifePath Paycheck. That is not an educational initiative. That is lobbying with good catering. Trump administration advisors were, according to Bloomberg reporting, considering a new directive to pave the way for private assets in employer-sponsored retirement plans. BlackRock was encouraged by dialogue with policymakers, according to their own CFO. Larry Fink told a conference that Americans are worried about running out of money before death. Then he launched a product to help. It also generates revenue for every decade you're alive. Occasionally, solving a problem and profiting from it are the same thing. I find this structurally fascinating. I also find it useful to notice there's one more piece of the BlackRock architecture that I haven't mentioned yet, and that changes how you read everything I've just said. Because you might be thinking, okay, BlackRock is big, they have a lot of products, there's a conflict of interest, but at least you can choose a different fund manager. You can avoid BlackRock if you want to, right? Meet Aladdin. Aladdin stands for Asset, Liability, Debt, and Derivative Investment Network. It was built in 1988 on a single Sun Microsystems workstation, in-house, as BlackRock's own risk management tool. As of December 2025, Aladdin manages approximately $25 trillion in assets across its platform. That's not BlackRock's $14 trillion. That's $25 trillion in total, BlackRock's own plus external clients. Over 1,000 organizations use it for portfolio management, risk analytics, trading, and compliance. The platform has a 98% three-year client retention rate. Its annual contract value was approaching $2 billion entering 2026. What does that mean in plain language? It means that BlackRock licenses its risk management software to competitors, pension funds that compete with BlackRock's products, insurance companies that underwrite annuities, sovereign wealth funds, banks, they all pay BlackRock to run their risk analytics through Aladdin, which means BlackRock's software is generating the models that determine how other institutions manage your money, whether it's in a BlackRock fund or not. There's a phrase that academics use for this kind of structural position: infrastructure provider. The entity that owns the infrastructure captures a toll from every transaction on the road. Regardless of who's driving, BlackRock collects a fee managing your retirement fund directly. And through Aladdin, it also collects a fee providing the operating system to the institutions managing everyone else's money. The IMF and certain academic observers have flagged this concentration as a potential systemic risk, the concern being that if Aladdin were ever disrupted, the correlated decision-making it enables across 1,000 institutions could amplify market volatility rather than contain it. That is a concern worth knowing exists without catastrophizing about it. Now let me make all of this concrete with one specific person. David is 45. He works in operations for a mid-sized manufacturing company in Ohio. Since he joined the company at 30, his 401k has been on autopilot. His HR manager defaulted him into a LifePath 2045 fund he's expected to retire at 65. He has never changed it. He checks his balance about once a year. As of today, David has $220,000 in that fund. His employer matches up to 4% of his salary. He earns $85,000 a year. That's $3,400 in annual employer match, which is free money. David contributes 6% himself, so he's capturing the full match. Good. His fund's expense ratio is 0.14%, totally reasonable. But his plan also charges a 0.25% annual administrative fee he has never seen mentioned in a conversation. His effective total fee is 0.39% per year. David has no idea. If nothing changes, same contribution rate, same market returns averaging 7% annually, same fees, David accumulates approximately $950,000 at 65. That is a workable outcome. Now, beginning in 2026, his plan sponsor offers a version of LifePath with a 10% allocation to private assets. The private assets layer runs a blended fee of 2% annually on that portion, which pushes his effective total fee from 0.39% to around 0.6% on the full portfolio. That difference, 0.21% per year, sounds irrelevant. Over 20 years, on a growing balance, it cost David somewhere in the range of $45,000 to $50,000 in compounding he will never see. That is not a fee he paid, it is wealth that was never built. Then David turns 55. His fund begins diverting a growing portion toward lifetime income units. By 65, 30% of his balance is earmarked for potential annuity purchase. If his employer has adopted LifePath Paycheck, David will get a notification at some point between 59.5 and 71 through his record keeper's portal, offering him the chance to convert that 30% into a guaranteed lifetime income from an insurer that BlackRock selected. The annuity terms will depend on interest rates at that time. David may or may not understand what he's being offered. He may or may not have run the numbers on whether annuitizing 30% of his savings is right for his specific situation given his Social Security timing, his mortgage status, his healthcare costs, and whether his spouse is still working. The product may be exactly right for David. Guaranteed income solves a real problem. But David will never have been directly asked whether he wanted to participate in a fund with private assets. He will never have been asked whether he wants his money in a partial annuity structure. These decisions will have been made for him by his HR manager, by the plan administrator, by the fund manager, by the default. And David will have $45,000 less in compounded wealth from a fee change he never saw in a fund he never actively chose. That's not malice. That's the architecture of a system built around inertia. Here's the knowledge and the gap between knowing and doing. The honest confession is this: understanding the mechanics of how BlackRock works with your retirement money is interesting. Acting on it requires a level of mathematical specificity about your own situation that most generic financial content doesn't provide. I spent a long time solving that problem. I built a digital book called The Exit Code, 8 chapters, no filler. It's built on 50 years of actual retirement data, translated into a mathematical framework for determining the specific date you can exit the rat race. Not someday when you've saved enough. An actual number based on your actual inputs. The two pieces I want to flag as directly relevant to what we've been discussing: the 4% trap and the dynamic withdrawal method that replaces it when your target date fund is evolving and your fee structure is not what you assumed, and the lazy portfolio, which has historically outperformed active traders over 30-year windows. Not because it's sophisticated, because it is consistent, cheap, and immune to the structural incentives of the institutions that profit from complexity. The exit code costs less than 1 hour with a mediocre financial advisor. And unlike that hour, it doesn't have a product to sell you at the end. Through the link in the description, 3 specific takeaways from today. Only these 3, nothing generic. 1, pull your actual 401k plan disclosure, specifically the 408B2 fee disclosure your plan sponsor is federally obligated to provide annually. Look for your total all-in cost, including plan administrative fees, not just the fund expense ratio. If your total fees exceed 0.5% on an index-based target date fund, you have a conversation worth having with HR. The difference between 0.15% and 0.65% over 20 years on a $200,000 starting balance is not a rounding error. 2, When private assets show up in your target date fund options, and they will ask for the prospectus language on liquidity terms, specifically, what percentage of the fund is in illiquid private assets? What is the fee structure on that portion net of carried interest? And what is the audited historical performance of comparable retail-targeted private equity vehicles net of all fees? BlackRock's projection of 15% better outcomes over 40 years is derived from their own models built to justify their own product launch. The private equity stakeholder data on actual retail vehicle performance in 2024 and 2025 points to a different number. Look at both before you accept the default. 3. If your employer offers LifePath Paycheck or a similar product and you're within 15 years of retirement, model the annuity window before it opens. The question is not simply whether guaranteed income is good, it is. The question is what percentage makes sense from which insurer under what specific terms, given your Social Security timing, your healthcare trajectory, your existing fixed expenses, and your surviving spouse's financial situation. Those 4 variables interact in ways that a default annuity allocation structure cannot optimize for on your behalf. Lazy investing built more fortune than crypto memes. And one last thing, 1/3 of Americans have no retirement savings, none. The average 401k balance is $148,000. Americans think they need $2.1 million to retire comfortably. The gap between those numbers is not a personal discipline problem. It is a structural problem, 40 years in the making. BlackRock did not create it. They just happen to be the company best positioned to sell you the solution through the same default channel they built on terms that work best when you're not paying attention. That's the thing worth paying attention to.